Good afternoon, ladies and gentlemen, and members of the press. The Monetary Policy Committee met on 23rd and 24th of May 2016 against the backdrop of challenging global and domestic economic and financial conditions. The committee assessed the global and domestic macroeconomic and financial development, the short to medium-term prospects for the domestic economy, and the outlook for the rest of the year. In attendance were 9 out of 12 members. International economic development. The committee noted with concern the tapered growth and continued decline in global output since 2014. At an estimated 3.2%, global output in 2016 was only 0.1 percentage points below 3.1% in the corresponding period of 2015. The sluggish global output was traced to weak fundamentals in both the advanced economies and emerging markets and developing economies, including increased volatility in global financial markets, sustained softness in commodity prices, sluggish global trade, resulting in persistent fragility, particularly in the emerging markets and developing economies. The United States economy slowed to 0.5% during the first quarter of 2016, a steep decline compared with 1.4% growth recorded in the last quarter of 2015. The deceleration in U.S. growth was attributed to contraction in non-residential fixed investment and energy businesses, a strong dollar which harmed exports, slowdown in government spending, and moderation in private consumption expenditure. Japan, which is currently in deflation, is projected to grow by 0.5% in 2016, the same as in 2015, on the back of persistently weak aggregate demand. The Bank of Japan's monthly asset purchase of 6.7 trillion Japanese yen resulted in the bank holding about 1/3 of outstanding government bonds, while the economy remained largely intractable, with a credit crunch indicating that the program may have lost its steam. In response to the contraction in credit, the Bank of Japan since January 2016 adopted a negative interest rate policy. Real gross domestic product growth in the euro area at 0.6% in first quarter of 2016 was a phenomenal improvement compared with 0.3% achieved during the last quarter of 2015. The European Central Bank, at its meeting on 21st April 2016, maintained the soft policy stance by holding its refinancing rate at 0%, lending rate at 0.25%, and deposit rate at minus 0.4%. The bank also maintained its monthly assets purchase program of 80 billion euros, hoping to further stimulate output growth and achieve its 2% inflation target. The Bank of England also retained its monthly assets purchase program, financed through the issuance of reserves at £375 billion. At the end of its April 13, 2016 meeting, the Bank of England retained its policy rate at 0.5% with a commitment to raise inflation to its 2% long-run path. Weaknesses in major emerging markets and developing economies, including low capital inflows, rising cost of funds, and continuing geopolitical factors, have been identified as key constraints to growth. Adverse commodity prices continue to provide strong headwinds against growth, defining other economic and financial conditions in the emerging market and developing economies. Consequently, the IMF, in April 2016 update, downgraded the 2016 growth forecast for this group of countries from 4.3% to 4.1%. disruptions to oil supply in Canada, Nigeria, and Kuwait, and demand spikes following expectations of a U.S. interest rate hike and build-up of crude oil inventories contributed to mild oil price recovery in April 2016. Inflation remains largely suppressed in the advanced countries, but tepid consumption, spending, and vulnerabilities in the financial market continue to hamper financial intermediation and growth. Consequently, the monetary policy stance in most advanced economies remain largely accommodative and most likely to be maintained throughout 2016. On the contrary, monetary policy in the emerging markets and developing economies could continue to diverge substantially, reflecting the diversity of shocks confronting them. The domestic economic and financial developments. In the first quarter of 2016, the Nigerian economy suffered from severe shocks related to energy shortages and price hikes, scarcity of foreign exchange, and depressed consumer demand, among others. Consequently, economic agents could not undertake new investments or procure needed foreign raw materials. Shortage of foreign exchange arising from low crude oil prices manifested in low replacement levels for raw materials, other inputs, as well as new investments. In addition, the energy crisis experienced in the first 5 months of the year resulted in increased power outages and higher electricity tariffs, as well as fuel shortages, which led to factory closures in some cases. The prolonged budget impasse denied the economy the timely intervention of complementary fiscal policy to stimulate economic activity in the face of dwindling foreign capital inflows. Aggregate credit to the private sector remained highly tapered, while credit to government grew beyond the program's benchmark for the period. The committee, however, noted that many of the prevailing conditions in the economy during the review period were outside the direct control of monetary policy, but hopes that the implementation of the 2016 federal budget, supported by relevant sectoral policies and easing supply shocks in energy and critical inputs, will provide the needed boost to the economy. Against this backdrop, data from the National Bureau of Statistics for May 2016 indicated that domestic output during the first quarter of 2016 contracted by 0.36%, the first negative growth in many years. This represents a drop of 2.47 percentage points in output from 2.11% reported in the last quarter of 2015 and 4.32 percentage points lower than the 3.96% recorded in the corresponding period of 2015. Aggregate output contracted in almost all sectors of the economy, with the non-oil sector declining by about 0.18% during the first quarter of 2016, compared with 3.14% expansion in the preceding quarter. Only agriculture and trade grew by 0.68% and 0.4% respectively, while industry, construction, and services recorded negative growth of minus 0.93 and minus 0.26 and minus 0.08 percentage points, respectively. Committee noted a further increase in year-on-year headline inflation to 12.77% and 13.72% in March and April 2016, respectively, from 11.38% in February of 2016. The increase in headline inflation in April reflected increase in both food and core components of inflation. Core inflation rose sharply for the third time in a row to 13.35% in April, from 12.17% in March, 11.11% in February, and 8.8% in January, having stayed at 8.7% for the 3 consecutive months from December 2015. Food inflation also rose to 13.19% from 12.74% in March, 11.35% in February, 10.64% in January, and 10.59% in December 2015. The rising inflationary pressures continue to be traced to legacy factors including energy crisis, reflected in incessant scarcity of refined petroleum products, exchange rate pass-through from imported goods, high cost of electricity, high transport costs, reduction in food output, high cost of inputs, and low industrial output. The committee observed that in an economy characterized by high import dependence, the shortage of foreign exchange provided some basis for price increases as currently being experienced. Committee noted that the economy needed to aggressively earn and build up its stock of foreign reserves in order to avoid distortions when faced with severe shocks. The committee further noted that the current inflation trend, being largely a product of structural rigidities and inadequate foreign exchange earnings, would continue to be closely monitored and in coordination with fiscal policy with a view to addressing the underlying drivers of the upward price movements. Monetary credit and financial market development. Broad money supply M2 grew by 3.49% in April 2016, a 1.29% growth from March level of 2.2% and compared with 3.67% in April 2015. When analyzed, M2 grew by 10.47% in April 2016 against the provisional growth benchmark of 10.98% for 2016. Net domestic credit grew by 7.87% in the same period and annualized at 23.61%. At this rate, the growth rate of net domestic credit was above the provisional benchmark of 17.94% for 2016. The development in net domestic credit essentially reflected the significant growth in credit to government of 35.97% in the month, annualized to 107.91%. Credit to private sector grew by 3.52% in April 2016, which annualized to a growth of 10.56%, below the benchmark growth of 13.28%. Committee observed with concern the continuous dismal performance of growth in credit to the private sector, noting that in spite of the bank's efforts, deposit money banks continue to direct credit largely to low employment elastic sectors of the economy, a phenomenon that had significantly contributed to the low performance of the economy. Money market interest rates reflected the continuing liquidity surfeit in the banking system. Average interbank call rate, which stood at 4.5% on 21st of March 2016, closed at 8.67% in March 18, 2016, and between March 25th and 14th of April 2016, interbank call rate averaged 2%. Committee noted a decline in activity in the interbank market in the period under review, which was due to the payment of FAC statutory allocations and the maturity of CBN securities. The committee also noted a further improvement in the equities segment of the capital market as the all-share index rose by 3.34% from 25,899.91 on March 24, 2016 to 26,763.86 on May 18, 2016. Similarly, market capitalization rose by 3.14% from 8.91 trillion to 9.19 trillion during the same period. However, relative to the end December 2015, the indices declined by 6.56% and 6.7% respectively. Globally, however, the equities market were generally bearish. External sector developments. The average Naira exchange rate remained stable at the interbank segment of foreign exchange market during the review period. Exchange rate at the interbank market opened at 197 Naira to the dollar and closed at 197 Naira to the dollar, with a daily average of 197 Naira to the dollar between March 25 and May 13, 2016. Committee therefore remains committed to its mandate of maintaining a stable Naira exchange rate. The Monetary Policy Committee noted the level of activity in the autonomous foreign exchange market, especially following the deregulation of the downstream petroleum sector, with attendant increased demand in the interbank market, thus further exerting pressure on the Naira. The committee recalls that over the last 2 consecutive meetings, it had signaled the imperative of reform of the foreign exchange market. In the intervening period, the committee interrogated the issues around the current foreign exchange market regime, tracing them to the low foreign exchange earnings of the economy. Consequently, in the committee's opinion, the key issues remain how to increase the supply of foreign exchange to the economy. The committee observed that while the bank has been working on a menu of options to ensure increased supply of foreign exchange, there was no easy and quick fix to the foreign exchange scarcity problem, as supply remained essentially a function of exports and the investment climate. The committee is aware that a dynamic foreign exchange management framework that guarantees flexibility could not replace the imperative for the economy to increase its stock of foreign exchange through enhanced export earnings. Consequently, such a structure must evolve to provide basis for radically improved investment climate to attract new investments. The committee recognizes the exchange rate as a very important macroeconomic variable, which must be earned by increased productive activity and exports, noting with satisfaction that the bank had made very significant and satisfactory progress with the reforms framework. The committee was of the view that the current adverse global and domestic economic and financial conditions and the imperative imposed by the demand and supply shocks to the domestic economy, and considering the express intentions of government as enunciated in the 2016 budget policy must respond appropriately as the market continues to demonstrate confidence in the bank's ability to deliver a credible foreign exchange market. Accordingly, Monetary Policy Committee decided that the bank should embrace some level of flexibility in the foreign exchange market. Given the imperative for growth, the management of the CBN has been mandated by the MPC to work out the modalities for achieving the desired flexibility that is in the overall interest of the Nigerian economy, and the implementation of the new framework would begin. Committee's consideration. The committee acknowledged the severely weakened macroeconomic environment as reflected particularly in increased inflationary pressures, contraction in real output, and rise in unemployment. The committee recalls that in July 2015, it had hinted on the possibility of the economy falling into a recession unless appropriate complementary report measures were taken by the monetary and fiscal authorities. Unfortunately, the delayed passage of the 2016 budget constrained the much desired fiscal stimulus, thus edging the economy towards contractionary output. As a stopgap measure, the central bank continued to deploy all the instruments within its control in the hope of keeping the economy afloat. The actions, however, proved insufficient to fully avert the impending economic contraction, with the conditions that led to the contraction in first quarter of 2016 still largely unresolved. The recession, which was signaled in July 2015, now appears imminent. To this effect, today's policy actions have to be predicated on a less optimistic outlook for the economy in the short term, given that even after the delayed budgetary passage in May 2016, the initial monetary injection approved by the federal government may not impact the economy soon, as the processes involved in the NBA's finalizing procurement contracts before the disbursement of funds may further delay the much needed financial injections and stimulus to restart the growth process. Committee noted that the CBN had implemented accommodative monetary policy from July 2015 with the hope of achieving growth up until March 2016, when the MPC switched into a tightening mode. However, while the underlying conditions necessitating tight monetary policy remained largely in place, sundry administrative measures implemented by the bank and recent macroeconomic conditions on the back of the budget of 2016 are expected to significantly dictate a key policy preference in the dilemma now faced by monetary policy, stagflation, and imminent recession. Given the current limited policy space, it is imperative to balance stability with growth stance while working on options that in the short term are certain to isolate seasonal and transient factors fueling the current price spiral. Other than credit to the government, growth in all monetary aggregates remained largely below their indicative benchmarks, yet headline inflation spiked in April of 2016. Inflation has continued to be driven mainly by side factors such as fuel scarcity, increase in the price of foreign exchange, persistent security challenge passed through to domestic prices of imports. While the committee believed that the recent deregulation of the dam would lead to increased supply, the pass-through effect of prices to other products has to be factored in policy consideration. Mindful of the limitations of monetary policy in influencing structural imbalances in the economy, the committee stressed the need for policy coordination with the fiscal authorities in order to effectively address the identified pressure points. The committee noted that continued excess liquidity in the banking system was responsible for the low level of activity in the interbank market. This is in addition to contributing to the sustained pressure in the foreign exchange market. Committee expressed hope that efficient implementation of the recently passed 2016 budget, especially the capital expenditure portion, will help invigorate growth in the economy as business confidence rejuvenates. Committee expressed concern over sustained pressure in the foreign exchange market and the necessity for implementing reforms to engender greater flexibility of rate and transparency in the operation of the interbank foreign exchange market. Accordingly, the committee noted that it was time to introduce greater flexibility in the management of the foreign exchange market. The committee reaffirmed commitment towards maintenance of price stability and reiterated the need to reappraise the coordination mechanism between monetary and fiscal policy and initiate reforms for the purpose of more efficient policy synchronization and management. Committee's decision. The committee, in its assessment of the relevant risk profiles, came to the conclusion that although the balance of risks remain tilted against growth, previous decisions need time to crystallize. Consequently, in a period of stagnation, the policy options are very limited. To avoid complicating the conditions, the committee decided on the least risky option to hold. The foreign exchange market framework now ready, the MPC voted unanimously to adopt a flexible exchange rate policy to restore the automatic adjustment properties of the exchange rate. Consequently, all 9 members voted to hold and introduce flexibility in managing the foreign exchange rate. The bank would, however, retain a small window for funding critical transactions. Details of operations of the market will be released by the central bank at the appropriate time. In summary, MPC voted to retain MPR at 10%, to retain CRR at 22.5%, to retain liquidity ratio at 30%, and also to retain the asymmetric corridor at plus 200 basis points and minus 500 basis points around the MPR. Also, the committee voted to introduce a flexible interbank foreign exchange market structure and to retain a window for critical transactions. I thank you for listening. MPR, sorry, correction. MPR at 12%.
Distinguished ladies and gentlemen, I think you've taken the correction. MPR is retained at 12%. That was the communique of the 250th meeting of the CBN MPC. It's now time for us to interrogate the communique. And please, strictly no diversions. Please, I beg you. Thank you.
Mr. Governor, my name is Ugo. I work for Premium Times. In your communique, you mentioned the impact of fuel several times. And you are well aware that 145 was the cap, the new fuel price that was capped 2 weeks ago. But the marketers were asked to source for forex outside the CBN, as the black market. We want to know exactly, because right now, prices of fuel outside Abuja have exceeded the 145 cap. So we want to know how did the CBN and other people that were involved in that process arrive at the decision of 145, when right now exchange rate for the dollar is about 380. So I don't know how, as a parallel market or the black market, let me call it black market, so that the price will still come at 145. And what rate do you guys fix the price? You help the market that's people decide at 145.
Thank you. Any more?
My name is Cliff. I was here for NTN News. CBN Governor, sir, it's just a little clarification, because you said that the CBN will retain a window for critical transaction and while operating greater flexibility in the management of forex. Will you be able to put that in percentage? CBN Governor, you did inform us here that CBN has adapted greater flexibility in foreign exchange management, and also said that the CBN will retain a window for critical transactions. Can you enlighten us a lot more into what constitutes critical transactions and what percentage is being allocated to that? Thank you.
Any more questions?
Yes.
No. Okay. Please step forward.
Thank you, Mr. Governor. My name is Mataya Zoku, and I work for the Guardian. So I would like you to shed no light on the flexibility that you talked about. Within being that, for instance, I'm going to restore the supply of forest to the PDCs. And how soon are you going to come up with this plan of yours that you said you want to elaborate? Thank you, sir.
Thank you. Please walk towards the side for the question.
Mr. Governor, sir, my name is Adejo. I write for the Nigerian Tribune. Yes, it's about the value of the naira. Right now, sir, the complaint all over is that nobody is able to buy the naira at the 197 naira to, sorry, the dollar at 197 naira. It's actually at the black market, and people get it. Investors have complained. We have read all over that is the main reason why people are investing, why they are not coming. I wonder, when is the CBN thinking about all this in taking its decision on forex?
Thank you. I think that's
Good afternoon, I'm Nancy, I anchor the Monitor AIT. Mr. Governor, please, I would like you to expatiate, especially when you talked about coordination between monetary and fiscal policy, because it seems the July 2015 MPC, you did warn of an imminent recession. It seems now the chicken has come home to roost. What are we going to be seeing from the fiscal side and the monetary side in terms of coordination? Because there's seemingly an imbalance.
okay. The governor will take the questions. Governor.
Thank you very much. Well, I think, let me start from the last one, coordination between the monetary and fiscal authorities. I think basically this has to do with the fact that the authorities certainly know what they need to do, okay? But I think what is important is that one aspect that is largely contributory to the situation we find ourselves today is the delay in the passage of the budget. Delay in the passage of the budget has created a few distortions in the system. You can imagine a situation where a budget is passed in May, a budget that should have been passed in January or even latest February. And I believe that, and the Minister for Budget and Planning himself has even committed that this will be the last time this will happen. Basically, the important thing is to note that a lot of activities are predicated on the passage of the budget. When the budget is passed, the money is available to be spent either for capital projects. Construction workers can get back to work. Roads can begin to be reconstructed again. People will buy gravel. People will buy sand. People will buy cement. Laborers will earn money. It will engender consumer purchases. And what you find that consumer purchases plus other expenditures constitute close to about 85% in component for GDP computation. So that's what we're trying to say. I think all of us must have learned from this sad experience, unfortunately, and I'm hoping that going forward we'll work together to ensure that we are well coordinated towards this objective. Shripon talked about the value of the Naira, that whether nobody is buying FX at 197, that is untrue. The central bank still sells FX at 197 to the dollar, but unfortunately the situation is that people are not able to get the quantum of dollar that they need. And I imagine that people can understand the fact that this is because what the central bank has in its kitty as a supply of foreign exchange is so inadequate to be able to meet the demand for the foreign exchange. So what we do is to provide what we have available and expect that buyers or those who require foreign exchange will resort to other sources. Shed more light on BDC. The flexibility we're talking about will be worked out, and a lot of details will be provided in the coming days. But of course, BDCs, they are part of the foreign exchange market, but I am not by any means saying that we are going to restore BDC as in providing dollars from the Central Bank of Nigeria to fund BDC operations. They will continue to operate at the autonomous market. What is the critical transaction? Talk about flexibility and plus foreign exchange for certain critical transactions. I am sure that some of us understand what we mean by critical transactions. There are people who would want to import plants and equipment to produce goods where raw materials are almost 100% available locally. We will support attempts by people to set up factories, foreign direct investments coming in, or even local direct investments coming in. If they want to import plants and equipment and their raw materials are almost entirely available locally, we will look for an opportunity to provide that incentive that they need to import those equipment so they can produce locally and stimulate growth. And of course, where we have people who are producing items where even the raw material content is so minimal, then of course naturally we will do that. Purely it will be for basic, very basic raw materials with contents that are very low in terms of import content, not people importing almost everything and they say that they want to import raw materials. Impact of fuel at several times. Well, I am surprised that you are saying that the price of fuel right now is above 145 naira. I'm aware of marketers even advertising that they are selling fuel right now at 108, 115, and 120. I'm aware. But the point here is that the central bank has never been part of the process for determining price of fuel. But what has been agreed is that the marketers will source their foreign exchange from independent sources, and I imagine that whatever there must have been an arrival in terms of whatever rate that led to 145. But I'm sure that even if marketers buy their foreign exchange at 300 naira, I know they will still make profit if they sell their fuel at 145. The template is clear. We have the basis for the template for that computation. We are even saying that even if they source their foreign exchange wherever from their own independent sources at 320 naira, they will still make marginal profit from the templates. Thank you.
Okay, it remains for me to thank everyone. You can see it has been a very eventful Communique day. And please, like we beg you, we appeal to you, a little bit of mispresentation can cause a huge cost to us in our pockets in terms of participants in the economy. Please, let's report. If there is anything you don't understand, call me. I will clarify. Thank you, and God bless you.